Welcome to this explainer. If you're an engineer, a technical pro, or honestly, just someone who loves figuring out how complex systems tick, you are in the exact right place. We usually think of engineering as what? Designing physical structures, right? Or writing software, or maybe optimizing a chemical plant. But there's actually another absolutely crucial system that needs engineering, and that's the business itself. So today, we're going to look at financial analysis, not as some boring accounting chore, but as a hardcore, essential engineering tool. We're literally going to break down the blueprint of a business.
Think about this for just a second. How do you actually turn a brilliant engineering idea into reality? You might have the absolutely perfect technical design. You might hold the most innovative patents or have the most efficient machinery on the planet. But is that really enough to get a project off the ground? Well, no. Because without the right fuel, even the most beautifully engineered engine is basically just a really expensive paperweight.
Okay, let's dive into this. Our source material hits the nail on the head here, stating, a business, apart from people, machines, knowledge, ideas, organization, also needs money to be able to support or finance its operation and the realization of its plans. It's simple, right? Money is the ultimate raw material. It is the core input you need to fuel literally any enterprise. And just like any physical material you'd use in a project, capital has a cost. It has constraints, and it absolutely must be managed with precision.
Part 1. The legal form. Building the frame of the machine.
So, before we just start pouring fuel into our business machine, we've got to look at the frame it's built on. The legal structure of an enterprise dictates how the money is handled, who's in control, and crucially, who holds the risk. We're looking at 4 main structures here. At the top is the OE, the general partnership. This means equal, unlimited personal liability. So if the business goes under, your personal assets are on the line. Yikes. Then, stepping down, we have the EE, or limited partnership. Here, some partners manage and take that full risk, while others just invest and limit their exposure. Moving down, there's the EPE, a limited liability company. Everyone's risk is capped at what they invested, but transferring your slice of the pie, kind of restricted. Finally, the AE, the corporation. Liability is strictly limited, and ownership is chopped up into shares you can freely trade. It's really the most robust frame for handling massive amounts of capital.
Now, what's really interesting about this is the shift from a traditional shareholder to a stakeholder. See, in a modern corporation, you aren't just answering to the folks holding the shares. A stakeholder is anyone with a vested interest in the business's operation and its future. We're talking about the employees running the day-to-day, the creditors loaning the cash, the suppliers, and even the broader society and local communities that the business impacts. The business machine doesn't just run in a vacuum. It sits right in the middle of a massive societal network.
Part 2. Fueling the machine. Let's look at internal versus external financing.
All right, so our machine is built, and we know exactly who's watching it run. Now, we need the fuel. Getting your hands on capital is arguably the most critical financial function of any business. But remember, acquiring this raw material always comes with a cost. You've got to be strategic. Fundamentally, a business faces a choice. Do we generate this fuel from within our own operations, or do we go out and hunt for it in the external world? Let's see what squeezing fuel from the inside actually looks like.
Internal financing is all about optimizing the engine you already have. The most obvious way? Retaining earnings. Just keeping the profits inside the company to fund new projects instead of handing them out to shareholders. But you can also squeeze capital out of your daily operations. You could revise your credit policies, basically demanding your customers pay you faster, or negotiate with your suppliers so you can pay them a little slower. You can minimize your inventory so your cash isn't just sitting there tied up in a warehouse. You can even sell off non-productive assets, like, say, an unused piece of land. But as any engineer will tell you, every optimization has a trade-off. Push your customers too hard, they might just leave. Cut inventory too low, and boom, you risk a total production halt.
Now, if that internal fuel just isn't enough, you've got to look outward. And external funding really splits down 2 very distinct paths: equity and debt. You're either giving up a piece of ownership in your machine, or you're taking on strict, legally binding obligations to pay someone back.
Let's tackle equity first. This is basically when you bring in partners. You could simply issue new shares to the public. Or, if you're a high-risk, high-tech startup, you might look at venture capitalists. They bring in money and expertise, but they usually want a quick, highly profitable exit. Then you have business angels. These are wealthy individuals investing their own money, often looking to get personally involved in the management for the long haul. And hey, sometimes you can even get state grants. This is government funding injected right into your equity because your project does some good for society, like protecting the environment or creating jobs in a specific area.
On the flip side, we have debt. Now, borrowing capital doesn't dilute your ownership, which is great, but it creates a relentless obligation to repay it, with interest. This could be short-term bank limits just to cover daily working capital or massive long-term bank loans for a huge expansion. Really large corporations might even skip the banks entirely and issue corporate bonds straight to the public. There are also some clever indirect methods like leasing. You're essentially just renting your heavy equipment over time rather than buying it all up front. Oh, and let's not forget state subsidies and tax reliefs. These act like indirect funding by just lowering your overall operating costs.
Part 3. The blueprint. Let's look at the balance sheet.
Let's move to and see how this builds into the ultimate diagnostic tool for our business machine. Think of a balance sheet like a super high-resolution photograph of a company's financial health, snapped on one specific day, usually the last day of the year. And this brilliantly illustrates the exact flow of our financial engineering in that snapshot. On the right side, we've got our sources of capital, that equity and debt we just talked about. These sources pump fuel into the center, the enterprise. The enterprise then takes that capital and deploys it over to the left side, converting it into active uses, the fixed assets and the current assets. Every single dollar has to be accounted for in this flow.
Let's look at the actual structure here. The balance sheet is split right down the middle into two equal halves. On the left, we have the assets. This tracks exactly where the money went, the uses of the capital. On the right, we have liabilities and equity. This tracks exactly where the money came from. Let's break these columns down just a bit more so we really get it. Starting on the left side, the assets, we actually see a split based on time. Fixed assets are your long-term tools. Think buildings, heavy machinery, patents, the stuff you're going to use for years to generate value. Current assets, on the other hand, are strictly short-term. These are the raw materials sitting in your warehouse, the invoices your customers haven't paid you for yet, and of course, the actual cash sitting in your bank account right this second.
Now, swinging over to the right side, the sources of that capital, we contrast equity and liabilities. Equity is the money conceptually owed to the founders and the shareholders. So the initial share capital and those reserves of retained earnings we talked about. Liabilities, however, represent real, actual external debt. This is money legally owed to outside parties. Long-term loans from the bank, short-term debts to your suppliers, and yeah, taxes owed to the state.
And this brings us to a really vital diagnostic metric, net worth. If you take the total assets, so absolutely everything the company owns and uses, and you subtract all the total liabilities, everything it owes to the outside world, what you're left with is the net worth. Conceptually, if the company liquidated every single asset it had tomorrow and paid off every single bank and supplier, the net worth is the theoretical value that would be left over for the owners.
Part 4. The fundamental accounting equation. Okay, we've seen all the parts. Now we arrive at the climax of this explainer. We need to look at the core mathematical equation that keeps this entire financial structure from just collapsing. It is literally the fundamental law of financial engineering. So the crucial point is this equation right here. Assets must equal liabilities plus equity. Always, no exceptions. Every single cent raised from an external bank or an internal shareholder must be exactly equal to every single cent deployed into a machine, an inventory item, or a bank account. The blueprint has to balance perfectly, because if it doesn't, your financial photograph is blurred and your business machine is completely out of alignment.
Understanding this blueprint is honestly what separates a good engineer from a great business leader. It's not just about building the product, right? It's about structuring the capital that makes the product possible in the first place. So I want to leave you with this to think about. Take a look at your own business, your current employer, or even the very next project you're designing. Are the assets on the left side truly working efficiently to generate value for you? Or are the liabilities on the right side quietly holding the whole system back? The numbers always tell the truth story. You just have to know how to read the blueprint.